like I always kind of tell people, if I could show you a way that on a guaranteed basis for the rest of your life, if you just, the only variable in the success is you and your ability to save, if you could increase your standard of living on a guaranteed basis for the rest of your life, is that something you'd like to learn about?
Yeah. And, you bring up a really important point, because you don't have to be starting with, a large sum of money either, right?
No.
You can start where you're at, but
Yep.
because it is that incremental increase of your standard of living, that's from wherever you are, right?
Totally.
So yeah,
I
it's
love
awesome.
it. Hey, what's going on, cash flow hackers? It's Chris with Life 180, and I am here with Liz Lamond. And today we're going to be talking about something that I think is really important for our Canadian friends, and that is, what is the difference between infinite banking in the United States and Canada? Because Liz, you and I have talked a lot about this, and I think sadly, there's not a lot of content up in Canada in regards to infinite banking, and a lot of people are watching pretty much US content exclusively, or predominantly at least, on how to get infinite banking set up in their lives. And so I thought it would be really beneficial for us to get on here, you being a Canadian, me being in the US, and kind of each of us having our depth of knowledge in each area, and talking about the difference, and having a conversation around what are the real differences in the policies.
Yeah, that's awesome. And I think the important place to start probably is to say that there's actually not as much difference as people may think. There are a few key things that we're going to talk about, but essentially many of the things are the same. So the tax advantage growth, the tax-free death benefit, those kinds of things are all the same between the US and Canada.
Yeah.
What else is there that's similar that we were talking about earlier?
Yeah, I mean, so you get the tax growth, tax-free growth, tax-free access to the cash if you access it the proper way. That's the same in the US and Canada, as long as you use the loan provisions. I think both of them have access to third-party lending, even if you want to. Like in the United States, you can use a cash value line of credit, which will get you cheaper than the loan provision. It comes with some fixtures as far as it's not an unstructured loan, so you'll have minimum monthly interest payments with a cash value line of credit. And is it an IFA? Is that what it is up in Canada?
Yeah, so there are a few products with different names, but yeah, mostly what's used is an IFA, and similar. There are interest payments required and some qualification, much like other sort of loans from a bank, but using the whole life policy as the asset that it's based off. So very similar kind of arrangement, I think, between Canada and the US.
Okay.
In terms of what the bank's expectations are as well, in terms of setting that up. But and the policy loan provision as well is available in Canada. Much simpler way to access capital, simply because it doesn't require qualification. There is an interest rate set by the insurance company that is simple interest, compounding once per year. And you can set the terms of your repayment of that loan. So that's very similar to what the US insurance companies offer as well.
Yep, totally. And so from that perspective, I guess at the end of the day, I mean, they're infinitely more similar than they are different. But before we get into the major difference, and we got a couple things that I think are really important to understand if you're considering getting an infinite banking policy in Canada for yourself. So make sure, stick around here. As we get into this though, let's talk about I want to hear you kind of tell all the Canadians watching this, or everybody, I'm sure there are some US people watching this as well. Why is it that you think people should get started with infinite banking? Like, give me your 2-minute sales pitch on why infinite banking is so important for everybody. Why you and I kind of believe that it should be the foundation of everybody's financial life.
Yeah, very simply put, it's because we're all doing something with our money anyway. It's just what we've been traditionally taught to do with it isn't actually very efficient. So keeping it in a place where we're not really getting any benefit from ongoing growth, the power of uninterrupted compounding, that itself is a game changer. And the thing that really sort of led me down this journey, and certainly is changing things for the people that I work with, is just the ability to have your money doing more than one thing at a time. So it's a very, very slow road when everything you do, your money's only doing one thing at a time. So it just in terms of having access to capital, growing your wealth and creating where you need to be. I mean, I think, you would agree, Chris, like, despite what might have been said in the last year or so, inflation has kind of been nuts. And so any kind of plan that doesn't involve ongoing growth of money is not going to get, people to where they need to be by the time they get to passive income stage. So having something that is working as hard as you are in the background, but you're also having the ability to, access capital to continue to invest. So it's a really great way to have a complementary asset. And something I really like about it, it's not an either or. So you're not saying, okay, well, I'm going to do infinite banking or I'm going to invest. I'm not, it's totally. The opportunity is to do both. And by doing both, you actually, enhance your results. And so that for me is one of the things I love most about this strategy is that I don't have to choose. So I really enjoy investing in real estate and I just am enhancing my results doing that. I'm not choosing which to do. And I'm also providing myself with a growing pool of capital that I can access that I can use for, the other things that are coming up in life, including opportunities as they arise.
Love it. I love it. I always, one of the things that got me really excited about this when I first started and the light bulb came on for me is one of the biggest challenges in the US, and I'm sure Canada is the same way, is we have all these people that are chasing these big returns and taking on so much risk. And, only in the financial industry do we tell people like the more guaranteed, like the best way to achieve what you want to achieve is to increase your chance of failure, right? Like that. Only in the financial industry do people buy into that garbage, right? Like, and somehow people have bought it hook, line, sinker for the most part. And it's sad. So the thing about this and what Liz was just saying is if you could learn a way to be more efficient with your money and get 1 or 2% more efficiency on every dollar that goes through your financial life, you don't have to worry about trying to chase big returns and putting yourself at risk, right? Because I mean, I do a thing called the Life 180 Pyramid Talk, and it talks about the fact we have 45 years, of our career that we work, and we know that the market is, cyclical. It goes up and it comes down, it goes up and it comes down. And during those down periods, typically people, after feeling like they did well for 8 to 12 years, they get kicked in the teeth, with the economy going bad, they lose their job, they got to liquidate, negatively performing assets, they got to pay taxes and penalty and all these things. And at the end of 12 years, you're kind of stuck not being much better off than you were to begin with. And when that happens, if you have one cycle like that in your career, it's really hard to catch up, And so by implementing a system like this, it gives you, like, I always kind of tell people, if I could show you a way that on a guaranteed basis for the rest of your life, if the only variable in the success is you and your ability to save, if you could increase your standard of living on a guaranteed basis for the rest of your life, is that something you'd like to learn about? Nobody's going to say no to that, right? Like, because, and what I love about it is we can genuinely do that for people, right? And show people how to accomplish it. And so that's the beautiful thing about this strategy overall.
Yeah. And, you bring up a really important point because you don't have to be starting with, a large sum of money either, right? No. You can start where you're at, but because it is that incremental increase of your standard of living, that's from wherever you are, right? Totally. So yeah,
I love it. I love it. All right, so let's get into this and give people what they came here for. So let's talk about the biggest differences between Canada and the US as far as whole life policies and infinite banking whole life policies specifically. How do we design them and how we're able to design them and structure them? And so I guess I'll just say the first thing, and we talked about this ahead of time, is the ability to get a large sum of money into the policy. You just kind of said it. You don't need a large sum, but in the United States, I think we have a little more flexibility to be able to put a lot of money in up front. Whereas in Canada, talk to me about how it works up there.
Yeah, so there's sort of minimums and maximums and a sort of a range that you can put money in.
Okay.
People will often come and ask the question. So I'm going to give an example. So
Sure.
just say you had $50,000 available and you
Mhm.
wanted to put that all in 1 year. People will ask the question, can I just put $50,000 in the first year and then pretty much very, very small amount, like $5,000 for every year thereafter? It doesn't work that way in Canada. You need to be able to put in a much more even amount. So instead,
Okay.
we might choose to put in like $10,000 over 5 years, or $5,000 over 10 years instead
Okay.
to fund that policy. So there's more flexibility in that, but just for the simplicity of the example, it can't be that stark a difference between what you're
Okay.
putting in the first year. So whatever we're planning to put in, we need to plan to put that in for around 7 to 10 years. And so,
Okay.
as I said, I can build a little bit of flexibility as to what that amount is, but not a massive difference.
Okay. So you're not able to do a big front load. Like, so in the United States, we can basically, the rule of thumb that I kind of go with, and it varies a little bit, but the rule of thumb is about 10 times the annual premium. So if you had 50,000, we could do about 5,000. Maybe it might be 6 or 7 that you need to commit to on an annual basis, but that's doable. Like one of our agents the other day had somebody that had 175,000 that they wanted to dump in and front load the policy, and they were able to do so with a $15,000 annual premium
Okay.
to
Yeah.
go along with it. So, which is great for real estate investing and the cash flow hacking stuff that we do, right? Like to be able to get that money in and turn it out. So what you're saying in Canada is you got to have a different strategy to go along with that. So like for real estate investing, what may make sense then, and talk to me about how you would handle this is, instead of, if you can't put all the money up front, put what you can up front and optimize the policy. And then if you have extra cash, get your real estate, use cash flow to then fund the policy.
Yeah, so yeah, it depends what you're doing, and there is some, depending on the amounts of premium we're looking at, there is some
Yeah.
flexibility to add in extra at the front end. It's just not
Okay.
going to be quite as big as what you might be able to, what you just explained you can do in
Okay.
the US. So
Okay.
this is a really good point to talk about with whoever you're working with, because so that they can base it on your objectives and your needs, because there are things that we can do to leverage it really well for real estate investors in what you said. And something that we mentioned earlier is how you access the capital even back out of the policy may change what you can do with that. So there's lots of kind of nuances to work through. So work with somebody who understands this and understands all the options that you have and can design the policy in the way to optimize it. And it's also going to depend on the insurance company. So different insurance companies in Canada, you have a little bit different level of flexibility in how you can use those policies as well. So really great to work with somebody who has an understanding of exactly the differences between those insurance companies, even in terms of what you can do with it for your investing.
Totally. Yeah, no. And to that point, guys, I would say this is Liz is amazing at this. So if you're watching this and you're curious, and if you are thinking about, what would this look like for me, I'm going to put a link down in the description below, and you'll be able to follow that link and reach out to Liz. And if you're in Canada, she is somebody that I would absolutely reach out to, have a conversation with. And so the other major difference is just policy design, right? Like, what do you guys call it? Do you guys call it paid up editions in Canada? I always forget.
Yeah.
You do. So it's all the same lingo there, as far as the paid up editions, the base to paid up editions ratio. But in Canada, I think we have a bit more flexibility in the United States than Canada does, from what I understand.
That's right. Yeah. In terms of how those ratios work with, sometimes in Canada, it's called, the accelerated deposit option or the additional deposit option, again, depending on the insurance company. All of those terms are fairly, interchangeable in terms of how people are talking about it. But the difference between how you build the policy, there's just a little bit more flexibility. That being said, some of the ways that people are talking about building those policies, that with the flexibility isn't always a good thing. So
sure,
I think,
totally.
you and I have talked about, we wouldn't necessarily agree with building a policy that would optimize it for someone in the way that you necessarily can in the US. So
Right.
it's not actually, it's, I think that generally you and I would probably construct a policy fairly similarly, even though there is that difference between what option you have versus what I have. But in terms of optimizing the policy, there's probably actually not that much difference between Canada and the US in terms of how we would recommend you actually build the policy.
Yeah. Well, so from that perspective, then, even though there are these two major differences, which aren't that major, or I'll say they're significant, but they're not that important, right? Like you can still execute, you can still implement infinite banking extremely effectively in Canada. You don't need big lump sums of money going in to the policy up front to do it. In fact, sometimes the flexibility to do so gets people's minds all twisted about, and it messes with why they're actually doing it in the first place. They're thinking about other things that don't really play into really what should be important as far as the foundational kind of long-term view of things. And I think, that is a big thing with infinite banking. This is a long-term view perspective, because, that's the biggest reason people struggle with their finances is everybody has a short-term view, right? Like we're going to do a video here coming up on our RRSPs, right? Like talking about how, like for us in the United States, it's qualified accounts and 401ks and IRAs and stuff like that. And when I talk to people about those, people love them, but it's such a short-term view perspective, on what's happening. And, you find out, you realize that, your financial planning and your success in your financial life really is going to be dictated. The success is going to be dictated based on your ability to have a long-term success plan. Right. And so that's what I love about this, is it forces you, with infinite banking, it forces you to have a system in place that gives you a set of rules in which you have to behave with to meet the success metrics of a long-term financial system for you to achieve the objectives that you want to achieve in your life, right? And that's a beautiful part. So as different as they may be in some areas on the funding and the design, the US flexibility is not necessarily a good thing, but at the end of the day, the foundation of this is all just properly designed whole life insurance, right? Like in whole life insurance as a foundational asset in Canada and the US at its core is very much the same thing.
Yeah, absolutely. And most of what we're teaching people around is a process as well. So the product has some differences between the two countries, but the process is exactly the same. The reasons for doing it are exactly the same. All those other pieces that we've talked about in terms of understanding the long-term growth of your own financial wealth, that's exactly the same across, both countries.
And we're talking the mutually held companies. Are they function the same way in Canada as the US?
That's a little bit different in terms of the differences between your options with mutually held, from what I understand of how the US mutual companies work.
Okay.
So certainly in terms of like a mutual company essentially just means in Canada that there are no shareholders. So there are companies where the people who own the whole life policies are effectively operating like the shareholders of that company, or non-mutual companies, there are shareholders as well as policy owners in those companies. So that's the difference. I think you can talk to the difference in the US between mutual and non-mutual.
Yeah. I mean, so a mutually held company is in the US is when you are the whole life policy holder, you are effectively a shareholder of the company. I mean, that's you participate in the profitability of the company. That's where the dividend in the whole life comes from. And that comes from investments in the general fund, the general account where all the money goes in. The insurance company manages all that risk, puts it into investments, they get a return, they pay that back. But the dividend isn't just, this is the other thing that people wonder right now, how can, a company give a 5.25% dividend right now when long-term treasury bonds are 1.8% right now or something of that nature. People don't understand how that works. Well, it's because the insurance company has a long-term view. They have 30-year bonds that are still on the books from the early 90s getting a higher rate of return. B, they're masters at managing long-term risk. Remember, we got to have a long-term view. And C, when you are a policyholder with a mutually held whole life company, a lot of the dividend is created also by the profitability of the entire company, right? So That's other product lines. It's term insurance, it's index universal life insurance in the United States, or universal life. It's other or annuity sales or anything of that nature. And so that's what the insurance company does, is they kind of manage the profitability of the entire company from their investments to their other product lines. And it's very predictable because that's the way insurance works. They understand and they can measure profitability and cash flow very effectively. So they know what that dividend is going to be basically a year in advance. And there's no fractional reserve banking, and there's none of that stuff going on in play, right? So that's why being a policy holder with a mutual company, to me, is the only way to go, because of the fact, at least in the United States, because of the fact that you're basically in business with a global, mecca company that, that has billions and billions and billions of dollars of assets, and you're just tagging on to what they're doing. Like I always kind of tell people, like, if you think you can go do better than, a company that's done it for over 100 years and has never missed a dividend payment, has succeeded in every economy, and has billions of dollars under assets, and is completely solvent and liquid and not leveraged right now, and can pivot and take advantage of every economic environment. Like, if you think you could do better than that, then, good luck. Like, that's,
Yeah. And I think that's a really important point, because, people say, well, this is new. Why haven't I heard about it?
right.
Actually, in Canada, this kind of policy has been available since 1847.
Oh, totally.
So it's been around a long time. Now, it hasn't necessarily been explained in this way in terms of the attributes that you can use, but you've had the possibility to use it in Canada since then. So this is not just, some new idea that's, now available, folks, but it's certainly something that has been, but quite misunderstood, I think, both in the US and in Canada, in terms of the power of how you can leverage all the pieces that you were talking about.
So you just hit on it. This is a real passion point for me, because I did a video a while, it was like 5 years ago or something of that nature. And I did a lot of research talking about whole life insurance as an asset, right? Like, even before infinite banking existed, and Nelson Nash created this concept in like the late 70s, right? And like kind of going down that route. If you understand history, and I don't know Canada, but I can speak to the US, and that's where this was created. And like, the infinite banking concept, or Nelson Nash is from the US, right? So before 1980, qualified accounts in the United States didn't exist. Now, I know that's a little different in Canada, but the idea is, everybody's like, well, why haven't I heard about this before? Well, that's because before then, over 60% of people in the United States saved money in whole life insurance before that period of time. But then in the early 80s, they created 401ks, they created qualified accounts, that, they try to get everybody into mutual funds. And now if you look online, if it's like, why do you not hear more about this? Is because there's infinitely more profit for the companies to sell you mutual funds, to sell you other investment accounts and all these other things. And that's where the marketing dollars are. That's where, like, when you watch, the Super Bowl, I guarantee you're going to see a Fidelity ad, a TIAA CREF ad, like all these companies that, like, if they can afford to put ads on the Super Bowl, like, where do you think that's coming from? You know what I mean? Like, it's padding their pockets, not yours. And so that's like, the marketing machine is what it is. And that's why you haven't heard about it, is because this is something that, quite frankly, has been done for a long time. People have sadly gotten away from it. And if you look at the past 41 years, 42 years since we've gotten away from it, and you look at the results financially in this world, they've become abysmal. So it's like, this isn't a new revolutionary thing. It's a throwback plan. It's like, it's going back to the foundational basics of implementing like financial stability and the financial foundation in your life. And what you do with that, like Liz said it earlier, it's not an either or conversation. It's doing this and doing some other stuff. And, we'll do a lot more videos on that, because this will end up being an hour long, but it's really fun. This is exciting stuff. And I think once you understand this and the light bulb goes off for you in your head, and you go, oh my gosh, like, where's this been my entire life? If I had a nickel for every time I heard somebody say that, it's, I'd be in good shape. I'd probably be in the Bahamas all the time. So anyway,
Yeah, I mean, I
Totally.
think I hear that a lot too. You know, I
Yeah.
wish I knew this about this 10 years ago. And you
Yeah.
know, so it's something that, you know, we're working to get the message right across North America that this is
Yep.
something that you can learn about and is available to you, and works very, very effectively, whether you're in the US or in Canada.
Beautiful. All right, guys. Well, so hopefully you found value in this. If you did, please hit that like button. Make sure you subscribe, hit the bell. That way you get notified every time we launch a new video. And Liz and I are going to be doing some more content here. So if you're from Canada, you're watching this, make sure you subscribe, because we got a lot more great Canadian content that's going to be coming out. And that's it for now. Until next video, guys, have a blessed, inspirational day, and we'll talk to you soon. See ya.